Hello everyone, this is Mirzai from Kapolei Pomona, and in this lesson we're going to continue the lecture for utility theory. So if you recall, in the second video of utility theory, we discussed about estimating someone's utility function given the most favorable and least favorable outcome. Then we allocated 0 to the least favorable outcome in terms of utility and allocated utility of 1 to the most favorable outcome. Remember, in that case, we fixed the probabilities as 1/2, and we asked the user to call a number here that makes these two lotteries exactly the same. So this is going to be the basic of our lesson today, because we're going to talk about the certain equivalent and risk premium. Today we're going to talk about the relationship between individual's utility function and her attitude toward risk. So before that, let's look at the certain equivalent definition. Certain equivalent of a lottery, which we show with C of L, is a value that makes a decision maker indifference between a lottery and receiving a certain payoff. If you give you 100%, what amount make these two lotteries exactly the same? That amount that the person provides here, this amount, we call it certain equivalent. So certain equivalent of this lottery here is going to be equal to negative $3,400. It means that if you lose $3,400, this is exactly the same as playing this lottery. Now, given the certain equivalent, we can define the risk premium definition. The risk premium of a lottery, or RP of L, is given by expected value of the lottery minus the certain equivalent of that lottery. So what is the expected value here? The expected value is going to be the multiplication of this value by this probability plus this value multiplied by this probability. If you find that value, the expected value, and see the difference between certain equivalent and the expected value, you can figure out the risk premium and whether the person is a risk taker or risk averse type of person. You can find out the behavior of people toward risk. So let's take a look at this example. In this example, expected value of the lottery is $10,000, and the certain equivalent the person provided is negative $3,400. And if you use this formula, expected value minus the certain equivalent, you get $13,400, which is the risk premium. Can you guess if this person is a risk averse or risk taker? So before we talk about the behavior of people toward risk, let's take a look at the definition of non-degenerate lottery. Non-degenerate lottery is a lottery in which more than one outcome can happen. We're going to get back to this definition later, but let's look at the attitude of people toward risk. A person is risk averse if and only if, for any non-degenerate lottery, your risk premium is positive. So in this case, because our risk premium was positive, then we can say the person is risk averse. Risk neutral is a person that for any non-degenerate lottery or any lottery that your risk premium is exactly equal to 0. It means that your expected value is equal to the certain equivalent, so the person is risk neutral. So a risk-taking person is for any non-degenerate lottery, a lottery that only has one outcome, your risk premium is negative. So if your risk premium is negative, you're risk-seeking. If it's positive, you're risk-averse. And if the risk premium is 0, you're risk-neutral. We can also associate this behavior to some the shape of the curve that you observe when you set up the utility function. So if a person is risk-averse, then their utility function is strictly concave, and if it's risk neutral, then it's a linear function. Their utility function is a linear function. It basically is both concave and convex at the same time. And if it's a risk-seeking person, the utility function is just strictly convex. So this is strictly concave graph. For a strictly concave graph, your second derivative is negative. So basically, if you're given a utility function, to be able to find out if the person is risk-averse or risk-taking, you need to calculate the second derivative of their function, and if it's negative, then the person is risk-averse. And if it's positive, then the person is risk-seeking or risk-taking type personality. If it's a linear function, if you take the second derivative as 0, and therefore the person is risk-neutral. So this shows you the strictly convex graph, and in this case the second derivative is positive. So if you're given a function, you calculate the second derivative and find out if it's positive or negative. To take the derivatives, your function, the utility function, should be differentiable. Otherwise, you cannot calculate the derivatives to find out if the person is risk-taking or a risk-averse type of personality. Let's look at one example. Suppose Joanne's utility function is given, and it's x to the power of 1/2, basically a square root of x. And in this case, you have some initial asset, which you have $10,000 in cash and $90,000 is your home. So your total assets is $100,000. There is a chance of fire, which the chance of fire is 0.001. So there is only 0.1% chance that there's going to be a fire in her house. So she would like to pay for an insurance policy that replaces her home. We want to calculate how much is worth for her to pay to the insurance company. Buying an insurance in this case is exactly like playing a lottery. Suppose that X is your annual insurance premium that you want to calculate and find out what should be this amount so it's worth for you to buy the insurance. So in the first lottery, we buy the insurance, and what happens is your asset position, if you buy the insurance, is going to be $10,000 cash plus your home, which is $90,000, so you have $100,000 minus X amount that you're going to pay for your insurance. So if you buy the insurance 100%, that's going to be your final asset position, regardless of fire happening or not. Because if the fire happens, the insurance is going to pay you whatever assets you had. But if the fire doesn't happen, you're still going to have that asset position. So buying insurance is going to be a lottery with the 100% chance of having asset position of $100,000 minus X, which is the amount that you're paying. In the second lottery, you don't buy the insurance. And what happens is, with 0.999, the fire doesn't happen, and you're going to end up with $100,000 asset that you had. So that would be one case. Or there is a probability of 0.001 that you're going to end up with a fire, and in the case of the fire, you're going to lose your home. Let's say your cash is still in the bank, so you're going to have your cash, but you end up losing your home, which is $90,000. So in this case, your final asset position is the cash amount that you have in the bank, which is $10,000. So in this case, and because we're given the utility function, we just don't look at the expected value of these two lotteries to find out which one is better. Well, we want to find out the utility of these two. To calculate the utility of this amount, I have to plug this into the function. I have to also do the same thing for the 100,000, also the 10,000, to be able to calculate their utilities. The only case that I buy insurance is when the utility of this lottery is bigger than the utility of the second lottery. When the utility of the first lottery is greater than the second lottery, we're going to buy the insurance. So we want to know in what case we end up having that situation. So from the first lottery, I put the U of 100,000 minus X. It means the utility of $100,000 minus X. And also I put U of 10,000 and U of 100,000. And we need to plug these numbers basically into the function of X to the power of 1/2 to calculate those values. So then you want to calculate the expected utility, which means that this value multiplied this probability plus this value multiplied by this probability. And in this case, because we only have one, the expected utility is just simply this value here. So let's do that. The expected utility for the first lottery is this amount. The expected utility for the second lottery is this amount. Now, if I want to end up buying the insurance, this expected utility must be greater than this one. So you're going to have this term greater than the second one. And if you calculate this equation, you end up with the X less than $136.71. You end up having a better utility from the lottery of buying insurance than the one that you're not going to buy the insurance. So basically, the conclusion here is that it's worth for her to pay for the insurance if it's approximately less than $137, because for any value of the insurance premium higher than the amount of X that we calculated here, she prefers the second lottery over the first lottery. Let's put that X here 136.71. Let's put that amount here and calculate the expected value of each of these lotteries. The expected value of the second lottery becomes 0.001 multiplied by the possible outcome, which is $10,000 cash, plus 0.999 multiplied by $100,000, and that becomes the expected value of second lottery, which is not buying the insurance. And in this case, what is our expected loss? If we don't buy insurance, our initial asset was $100,000 minus the expected value of the second lottery, you get $90 in loss. So if you don't buy the insurance, your average loss or expected loss is going to be $90. Replace that X by 136.71, and this two lottery becomes indifferent, basically. That's where these two lotteries are exactly having the same utility, expected utility, and they're indifferent. But anything less than 136 is going to make buying the insurance a more favorable lottery, and anything above that makes the second a favorable lottery for Joanne. Now, what is the certain equivalent? The certain equivalent, remember, is when these two lottery are exactly indifferent, we call it certain equivalent. So the certain equivalent of this lottery of not buying an insurance is this lottery with 100% gives us $100,000 minus 136.71. So the certain equivalent of lottery 2 is equal to 99,863.21. Now, what is the risk premium? Is the difference between expected value of the second lottery that we calculated up here minus the certain equivalent of lottery 2, which is given here, and that becomes $46.71. Your risk premium plus your average loss is equal to the insurance premium that you're paying. 90 plus 46.71 gives you exactly 136.71. So you see what happens. The amount that you're paying for your insurance premium is going to be based on how much in average you're going to lose plus your risk premium. So I want you to do an exercise and try to calculate the insurance premium for your car. I hope this doesn't help you to understand the meaning of insurance premium, risk premium, expected loss, certain equivalent. With this, our lesson has concluded. Please refer to your Blackboard for your assignments. In the next lesson, we're going to look into another example, and I hope that clarifies more of these topics. Thank you.